Hello and welcome to the CNBC-TV18 Mumbai newsroom. I'm Sonal Putra and with me is Pavitra Parekh, and you're watching this brand new edition of Mutual Fund Corner. We've spoken about a lot of things, a lot of segments as well, but today we are going to be talking about business cycle funds. What really they are, the advantages of investing in one, why is it good to have a fund like that? But as always, we'll point out all the risks for the investors and the viewers as well. Good afternoon, Pavitra. Talking about business cycle funds, excited to learn something new.
Exactly. This is not something that we talk about much, right? So I think it'll be helpful for our viewers as well. But let me invite our guests on the show today. We have Ashish Naik, who's Equity Fund Manager at Axis AMC, as well as Ashwin, Patni, Head of Products and Alternatives at Axis AMC. Gentlemen, very good morning and thank you for joining us today on this episode where we're going to do a deep dive and really understand what business cycle funds are. Ashish, if I can come to you first, like I was just mentioning, this is not something that we talk about too much, and I feel like a lot of people just don't know about what these funds are. So if you could help our viewers and take us through what exactly is a business cycle fund.
Thank you very much, and good afternoon to you too. Yes, so what do we mean by a business cycle fund? A fund which actually takes advantage of movement in terms of a cycle or repetitive movement in various businesses. Any business has what we call as a business cycle, which means there is a movement because of demand and supply. That means when demand is higher, prices are moving higher, then at some point of time, supply increases. And then obviously to that extent, prices also react accordingly. So to that extent, while there are these business cycles happening, we expect there are about four phases in every business. For example, expansion, peak, a slowdown, as well as a trough. It's not just the businesses, or it's actually even the economy that goes through these various phases. And there are various indicators that actually measure them, such as PMI, credit growth, unemployment, and various other economic variables. Now, obviously, when one can identify the business cycles right, there is obviously an investment opportunity. And in terms of analyzing a business cycle, that means identifying several indicators and then building a coherent investment opinion. A typical business cycle fund will try to identify the current phase of an economic cycle, narrow down on which sectors can outperform in that phase, and then choose companies in those sectors. In addition, there are various sectors that can actually have their own sector cycles which are different from the economic cycle, and identifying them and investing them at the right point of time also becomes important to run this sort of a fund.
Okay, interesting. We'll come back to you, Ashish, with more questions, but we also have Ashwin who is joining us now. Ashish spoke about what business cycle is and a brief understanding of how business cycle funds also operate, or how do they look at investing in different sectors. Your take on this one, what are the advantages here and what do these funds really benefit from? What is the working cycle that fund managers look at when they actually launch a business cycle fund?
Yeah, hi. So I would say this is pretty much to answer probably the last point first. There's no real good time or bad time for a business cycles fund because, as Ashish was explaining, the whole point is that the economy will go through cycles. And we have traditionally funds that have tried to sort of look at the investment approach, which can work across cycles, slightly more secular in nature. But you also have cyclical opportunities that keep getting thrown up because of the cycles that are there in the market. And while traditional funds will allocate to such opportunities, the allocations, the exposures could be more muted. And that's where having a dedicated cycles fund can really help, because you can give justice to these opportunities and really make, take meaningful exposures to such opportunities. So tying in these two things together, the opportunity is there in terms of capturing or benefiting from these cycles and the opportunities that are getting thrown up from it. The timing, there is not a good time or a bad time. Ultimately, all equity investments, you need to be a long-term investor. But obviously, whatever time investors come in, one of the benefits they get is that the portfolio will keep sort of updating itself or refreshing itself with respect to whatever the current cyclical opportunities are.
All right, got that. Coming to Ashish again, Ashish, what do you see as the key advantages of a business cycle fund? So if if there's an investor, why is it good for him to have a fund like this in their portfolio? That's one. And also, you were mentioning the timing where perhaps it keeps getting rejigged. Do you think that someone with a shorter time horizon then can still dabble into this place?
Sure. So a typical business cycle fund will try to focus on specific sectors with a, let's say, medium-term target in terms of growth triggers of, let's say, 2 to 3 years, and identify opportunities to benefit from either earnings upgrade or maybe valuation re-rating as well. A meaningful allocation to these sectors is how they, and building a conviction-driven portfolio is how it tries to participate in the growth story. Additionally, as Ashwin also mentioned, it looks at restructuring this portfolio as the business cycle plays out, which means that the investor can benefit from transitions to a new portfolio basis a changing business cycle. So to that extent, in terms of your second question of let's say, for example, an investor with a shorter term horizon, maybe less than 4 to 5 years, should probably not look at a business cycle fund per se, because that is the general time that one needs for this sort of fund to sort of cycle in a various sectors to play out.
Okay. So my next question is actually to you, Ashwin, because we've spoken about how it's advantageous. Why are we looking at sector selection here? Can you explain with some examples which one works in which cycle and how critical it is to the entire process here?
Absolutely. I think the beauty of the business cycle approach is that traditional investments could be structured more bottom up, where you identify best ideas basis work across different companies and sectors. But the beauty of the business cycles approach is that you are able to combine this bottom up approach with a very top down understanding, a top down appreciation of what is happening at the broader economy level and what are some of these trends leading to in terms of impacts on individual sectors and stocks. In terms of examples, we and Ashish has alluded to a few, but just to take an example, typically, if you look at economic cycles, you have classically a growth cycle, you have recessions, you have sort of within growth, you could have a situation where the growth is accelerating or growth is coming down. And different sectors respond differently to these things. Typically, what you see is that when growth is strong and getting stronger, typically that's a great environment for consumption-oriented sectors, for cyclical-oriented sectors, which are investment-oriented. When the growth is weakening or you're getting into a more recessionary environment, that's when some of the more defensive sectors could become a little bit more relevant. So that's the beauty of this, that you're able to apply this top-down understanding to what is classically a more bottom-up exercise of fund management.
Okay, that's very helpful on how the sector selection really works inside of this entire category of business cycle funds. We'll talk more about that, and we have lots more questions as well. But gentlemen, I request you to please stay on. We do have to take a quick break, but we'll be back in just 2 minutes and we'll continue this conversation. You're still tuned into Mutual Fund Corner here on CNBC TV18, and today we're talking all about business cycle funds, what they are, how you can really go about investing in them and how they work. We still have Ashish Naik and Ashwin Patni with us. So Ashwin, let me come to you first. I'm very glad that we're having this conversation actually one day after the budget, because it makes sense to, discuss this at a time when we've seen this huge capex push from the government. We have been speaking about this before as well. There's been a huge push towards infra. How do you look at these measures that came out of the budget?
I think the budget has done a great job in terms of setting clear priorities, which will help, the long-term growth story of the country. We've seen this also a continuation of some of these things which have been put in place over the last few years, which is, a big push on high-quality spending across investments and capital expenditure, promoting domestic manufacturing, and both of, in a way, sort of go hand in hand, in my view, in terms of the virtuous cycle that they can help create in terms of the economic growth. So I think what it means in terms of the cycle is that, as we all know, we're going through a scenario where after this massive reflationary growth that we saw in 2021, early 22, we're facing a situation where, thanks in part to the strong inflationary response by central banks across the world, and partially because of cooling down, we're seeing a scenario where growth is coming off across the world, and especially so in some of the big developed markets. So we are seeing a scenario where we're perhaps faced in a scenario where growth, while it's good, but the the trend is one where it is looking to get probably a little weaker. And that's where the budget was very important, because it set the stage that the government is going to continue to sort of keep supporting high quality capital expenditure, continue to support growth in the economy. And that is what we really need at this juncture in terms of our current journey.
Okay, point taken. Ashish, let me come to you, because we are in a business cycle where you are looking at a big capex push. You're talking about infrastructure. So it looks like we are on the peak cycle, or at least in the growth cycle as of now. So at this point in time, who should consider investing in a business cycle fund? What portion of an investor's portfolio should be allocated to such a fund? And in general as well, in different cycles, which funds would work or which sector would work here?
Right, absolutely. So one thing is very clear, as Ashwin rightly mentioned, that we are now seeing a huge amount of capex push by the government. And even if you look at India's growth story over, let's say, the last few years, we have sort of missed out on a big investment capex upcycle, at least for the last most of the years in the last decade. To that extent, while consumption was the bigger driver for the economy in the last decade, both investment as well as capex on manufacturing and infrastructure is actually going to be a big driver in this decade. To that extent, we believe that there will be many more opportunities in not just in the consumption, but also on the B2B, which is much more cyclical in nature in terms of opportunities to invest now. To that extent, we believe that Axis Business Cycle Fund is actually coming out at the right stage in terms of capturing these opportunities from a 2 to 3 year time horizon perspective. The other thing you mentioned about in terms of which sort of investor should look at it, ideally an investor who has a slightly higher risk appetite should look at this kind of a fund, because over a period of time, when in expansionary times, we might have a slightly higher tilt towards mid and small cap companies, as well as slightly more cyclical companies in nature in this sort of a fund. So to that extent, risk appetite is very important here for an investor.
Oh, absolutely. And like you mentioned, someone who perhaps has a time horizon of at least 4 to 5 years, right? Because, I mean, that is the kind of cycle that you do need to keep if you are investing in these funds. Ashwin, coming to you once more, we've already spoken about who this works for, what are the advantages. But like every other fund, there are risks as well that you should keep in mind, right? So what are the kind of risks that you would advise an investor keep in mind before he ventured into this space?
Absolutely. I think the way to look at this product is that, if you look at the trajectory of equity products, on the one side, you have your typical diversified products, which let's say could be large cap or multi-cap, flexi cap. And on the other extreme, you have very, very narrow products like sector funds, etc. The business cycle fund falls somewhere in between, where you are probably taking a much more focused exposure on certain themes or cycles, but you're not as single sort of exposure as a sector fund is typically is. So even from a risk perspective, therefore, I think that it falls somewhere in between. From an investor's perspective, what they need to keep in mind is that they should expect to see a more sort of focused portfolio across a few themes, across a few areas, which obviously in as per the fund manager, which are the areas which are benefiting from the current cyclical environment. To that extent, it obviously can work much better, because you get the benefit of that exposure, but also that is what brings the risk as well, because it's of course if the focused part of it becomes slightly more. Ashish already mentioned that there is also a scenario where a product like this will and will take more exposure to mid-small cap stocks as well. Again, that is a source of opportunity, but is also a risk that investors should be mindful of.
Oh yes, risks of course should be put on board along with the advantages of any sectoral fund as well. Ashish, that takes me to the next question. If today one has to go ahead and look for a business cycle fund, what are the ways to evaluate it? Is it basis the returns? Is it basis cycle? Of course, that is something that the fund managers will guide. But how do typically the returns work here? And what should an investor look out for other than the risks and advantages that you mentioned? Anything in particular?
Absolutely. So in terms of this kind of a fund, it will always try to look for newer opportunities in newer sectors. Probably what we call as in terms of an approach, look at the overall economy, try to identify sectors. At the same time, look at specific sectors, which is a sort of a top-down approach of identifying which sectors to invest into, and eventually, sort of pick up stocks in those sectors, and hence have a sort of a hybrid approach of investing. In terms of what these funds should be evaluated on, clearly, it is obviously at the end of the day, trying to beat relative benchmarks and try to obviously give consistent returns over a longer period of time. But in terms of evaluation, we believe that because we are taking slightly higher, let's say, more cyclical approach, to that extent, this fund will be probably less diversified compared to pure diversified flexi cap kind of a fund, and hence probably it should be evaluated over the time horizon that we mentioned of about 4 to 5 years. At the same time, because it is taking slightly higher risk, hopefully the active returns should also comparatively be higher.
All right, we understood that, and that is very helpful to know. Ashish, just one more question. You did mention very briefly the Axis Fund NFO, which is actually starting today. By the way, it goes on till the 16th of Feb. Can you take us through a little bit about this fund? And, a question that we get a lot whenever we sort of put out a question to our viewers is, if they are looking at business cycle funds, how is it really different from looking at, say, a sector fund? If, a business cycle fund is looking at infra for now, that versus a fund which looks at a similar thing, or a theme-based fund, how does it differ? If you could help us with both of those.
Sure. Clearly, a fund which is trying to do business cycle investing will look at various sectors at various points of time. There could be a point of time when infrastructure is actually is the thing that is actually cyclically growing from a 2 to 3 year perspective, and hence there will be a focus on that, and hence quite similar to, as you mentioned, an infrastructure fund. But even on an ongoing basis, a business cycle fund will not necessarily focus only on one particular industry. It will try to look at various opportunities and try to diversify across various industries in terms of which sectors or industries are doing well, depending on, let's say, government policies, depending on how the overall environment for that industry is improving. At the same time, this fund will also look at the overall economy, and if there is an expansionary trend, maybe look at more cyclical sectors. And while maybe if there is a relative slowdown or uncertain times, look at counter-cyclical as well as to some extent slightly less cyclical kind of defensive sectors. To that extent, this fund will be much more diversified versus a pure sector fund such as infrastructure, as you mentioned. And at the same time, it will be slightly more concentrated compared to a well-diversified flexi cap fund. So to that extent, the risk return will always be somewhere in between for this sort of a fund.
Okay, Ashwin, Ashish, thank you so much for joining us. We would have loved to chat a little more, but out of time on the show, but definitely learned a lot. So thanks a lot, gentlemen, for joining us and speaking to us on Mutual Fund Corner. And with that, it's a wrap on this edition of Mutual Fund Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.